Ric Edelman, The Truth About Crypto, a practical, easy-to-understand guide to Bitcoin, blockchain, NFTs, and other digital assets. Embark on a journey through the world of cryptocurrencies, blockchain technology, and digital assets by delving into Ric Edelman's The Truth About Crypto. An enlightening read for anyone looking to understand the intricacies of the growing digital economy. This book tackles various aspects of blockchain, the birth of Bitcoin and its role in replacing fiat currency, as well as the impact of cryptocurrencies on multiple industries. Witness the revolution of business through decentralized and transparent transactions and explore the wide range of investment opportunities in the digital asset sphere.
The disruptive power of blockchain. The traditional economy has always relied on trust. However, blockchain technology introduces an authentication economy that operates on a distributed ledger system. This system records every transaction publicly, which reduces the complexity of transactions. Example, real estate transactions that require weeks of mortgage approvals and title searches can happen immediately. But this is just the beginning. Blockchain promises to make title insurers, settlement attorneys, insurance agents, stockbrokers and ticket resellers obsolete. The transparency of the blockchain system makes it foolproof against any fraud, and once a record enters the blockchain, it becomes permanent and unalterable. Simply put, blockchain technology revolutionizes businesses. The rise of Bitcoin. Bitcoin emerged in 2009 during a time of global economic crisis, quickly gaining popularity as a new cryptocurrency. With limited supply totaling 21 million coins, fierce competition among Bitcoin miners has driven up the price and resulted in specialized $12,000 mining rigs. As of 2022, 18.5 million coins have been mined, and 4 million have been lost. Despite uncertainties and risks, Bitcoin has now become mainstream, accepted as payment by credit card issuers, retailers, and even mortgage companies. Transaction volume exceeds $1.5 trillion annually, surpassing that of PayPal. Bitcoin's shortcomings and cryptocurrency alternatives. Bitcoin's goal of replacing government currencies has been hindered by its volatility and slow transaction speed. Other cryptocurrencies such as Tether, Litecoin, and Ether were created to address these issues. Despite skepticism, the value of currencies is based on consumer trust rather than tangible assets. The digital asset ecosystem continues to evolve. The future of currency. Analyzing the factors that make a currency valuable, the author of this book explains why digital assets are here to stay. While Bitcoin's volatility undermines its status as a currency, new cryptocurrencies known as stablecoins are pegged to fiat currencies like the US dollar. Governments across the world are shifting towards digital currencies as physical money presents issues with traceability. Many nations, including China, Russia, and Japan, are testing virtual money, and the Bahamas has already introduced a central bank digital currency, CBDC, called the sand dollar, confirming governments' growing interest in digital assets. Gold versus Bitcoin. While gold has long been touted as a superior alternative to fiat currency, Bitcoin enthusiasts argue that comparing it with Bitcoin is pointless. Gold's bulk and increasing supply are drawbacks, which do not provide a hedge against inflation consistently. Bitcoin, on the other hand, is seen as a hard asset with a finite supply not correlated with equities. As such, the two asset classes have nothing in common, and should never appear in the same sentence. Digital asset investment strategies. Discover different ways to make money with digital assets, from mining and buying coins to yield farming and venture capital funds. Are you interested in investing in digital assets but don't know where to start? This book's summary highlights several strategies that investors are currently using to profit from the digital asset revolution. The first strategy is mining. If you have the technical expertise and funds to invest in mining rigs, this can be a profitable approach. By solving math problems, you can earn coins, and if the value of those coins is greater than your expenses, you will turn a profit. Another way to invest in digital assets is to buy coins or tokens directly. Dozens of digital asset exchanges make this process easy, including Binance, Coinbase, Gemini, Kraken, and Robinhood. You can also lend or stake your coins to others and earn interest, a process known as yield farming. However, yield farming is a risky endeavor, so caution is advised. If you're looking to invest in the infrastructure surrounding digital assets, consider a picks and shovels strategy. Just like Levi Strauss during the gold rush, you can make a profit by selling supplies to miners. In the digital asset world, investing in blockchain infrastructure can be a profitable approach. For the more advanced investor, buying derivatives such as options, futures, forwards, or swaps based on the future movements of digital assets is also an option. However, this is a high-risk approach, as the leverage involved in these contracts can magnify gains and losses. If you're interested in venture capital, you can invest directly in a venture capital fund for early-stage companies. However, beware of the risks, as capital is typically locked down for 5 to 10 years, and minimum investment requirements can be as high as $10 million. In conclusion, there are several strategies available for investing in digital assets, but caution should be practiced due to the high risk involved. From mining and buying coins to yield farming and venture capital funds, choose wisely and consider investing only what you can afford to lose. Maximizing your Bitcoin investment. Bitcoin's history shows that most gains come in just 10 days of the year. To avoid missing out on these gains, using dollar cost averaging, a strategy that allows for incremental investments, is recommended. Compared to investing a lump sum, dollar cost averaging is less risky and can help mitigate losses in the event of a crash. Investors who followed this strategy would have had smaller losses in the 2018 Bitcoin crash and would have broken even sooner. While investing nothing is a mistake, so is investing too much. Instead, using dollar cost averaging allows for steady investment into digital assets like Bitcoin. Overcoming objections to investing in blockchain. Many investors are hesitant about investing in blockchain due to common objections such as fear of digital assets, considering it a fad or fraud, uncertainty on value, volatility, risk, etc. However, these objections need not prevent you from investing in blockchain, as it can provide several benefits, including diversification, higher returns, and protection against inflation. Investors need to distinguish between fads and trends, and digital assets are a legitimate trend. No credible asset class is any less susceptible to scams, and decentralized pricing in blockchain is an advantage. Volatility is an opportunity to benefit from the eventual rise of digital assets. By investing a small fraction of the portfolio, investors can mitigate the risk of digital assets. Digital assets have the potential to zig when the rest of the market zags, providing diversification. Waiting for the next decline might not be a good idea, as prices may run away from you. Talk to a financial advisor to get started on investing in blockchain.
Having explored the complex but rewarding realm of cryptocurrencies, blockchain technology, and their various applications, it is clear that their presence is not simply a fad but an integral part of the ever-evolving digital landscape. By effectively using strategies like dollar cost averaging and working with trusted financial advisors, an investor can navigate the risks associated with digital assets while reaping potentially significant gains. Whether investing in digital currencies or utilizing the power of blockchain in everyday transactions, the future of the global economy appears to be inextricably linked to the disruptive potential of these digital innovations.